All right, welcome back to our ongoing explainer of ASC 340-40. If you were with us for the last section, you'll remember we walked through the incremental test for costs to obtain a contract. Basically, we learned exactly how to figure out what qualifies for capitalization when you're out there hustling to win business. But today, we're shifting gears. We're going to look at a massive time saver, specifically when you can just skip capitalization entirely. And then we'll flip the coin to see exactly how we should handle the costs you incur to actually fulfill those contracts. So here is our roadmap for this explainer. We're going to cover the practical expedient, how to avoid its traps, the preliminary scope check, the 3 fulfillment criteria, and finally, we'll run through some real-world fulfillment scenarios. Starting right off with part 1, the practical expedient, where we look at expensing short-term costs immediately. Okay, so think of today's framework as a 2-path journey. Path A is our exemption rule, and let me tell you, this is an absolute favorite for accountants who want to avoid unnecessary headaches. Now, why do we even need an exemption? Well, capitalizing costs and then meticulously amortizing them month over month is a pretty heavy burden. I mean, tracking every single $50 sales commission over a 6-month period, that is, quite frankly, an accounting nightmare. So to solve this, the standard gives us the practical expedient. It's an election that allows a company to just expense incremental contract costs immediately, skipping capitalization entirely, as long as the amortization period would be 1 year or less. The whole point of this is just to save you an immense amount of time and effort when dealing with short contracts or high-volume, low-value commission structures. But how does this actually look in practice? Let's say you have a super straightforward 1-year contract, and you don't expect it to renew. The amortization period is 12 months or less, so boom, you apply the expedient, you expense it immediately, and you move on. Easy. But now, what if you have a 3-year contract? Well, the amortization period is 3 years, so you've got to capitalize it. No shortcut available there. But here is the massive trap that catches people off guard. What about a 1-year contract that is highly likely to renew? You see, the practical expedient is evaluated based on the expected amortization period, not just the ink on that initial contract. So, if you expect renewals and that commission relates to both the initial term and the renewals, your expected benefit period suddenly stretches beyond 1 year. The expedient vanishes. You absolutely must capitalize it. Which brings us perfectly to part 2, avoiding expedient traps, specifically the consistency rule. Look, while the practical expedient is incredibly helpful, misapplying it is a very, very quick way to attract unwanted attention from an auditor. The absolutely crucial detail you need to remember here is that this is an accounting policy election. It's not a contract-by-contract choice. You can't just wake up on a Tuesday, look at a huge stack of 1-year contracts on your desk, and say, you know what, I'll expense these 5 because I'm super busy today, but I'll capitalize these other 2. No way. It's an all-or-nothing policy election. Once you elect to use it, you have to apply it consistently to all contracts with similar characteristics, and you have to disclose this election and apply it in all future periods. If an auditor catches you cherry-picking when to use the expedient, that's an outright audit failure. Consistency is literally everything here. Moving right along to part 3, the preliminary scope check. Think of this as the gateway to ASC 340-40. So we are now shifting over to path B, costs to fulfill a contract. But wait, before we even peek at the rules for capitalizing fulfillment costs under ASC 340-40, we have to pass a really important gateway. I want you to think of this initial step like a giant stop sign. Before you apply ASC 340-40, you have to check if your fulfillment costs actually belong under a totally different accounting standard. For example, are you producing physical goods for a customer? Stop. Use ASC 330 for inventory. Are you building internal use software? Defer to ASC 350-40. Buying heavy machinery to fulfill a contract. That falls under ASC 360 for property, plant, and equipment. You always have to account for costs under those specific standards first. It's only the leftover costs, the ones that don't have a natural home somewhere else, that fall through the gateway to us here in ASC 340-40. Let's dive into part 4, the 3 fulfillment criteria, also known as the rigorous capitalization test. Okay, so your costs made it through the gateway. Awesome. Now they face this rigorous test to figure out if the costs you incurred to actually perform your promised obligations can be capitalized. To capitalize a fulfillment cost, it has to meet 3 very specific criteria. Step 1, the costs directly relate to a specific contract or an anticipated one. Step 2, the costs generate or enhance resources of the entity that will be used to satisfy performance obligations in the future. And Step 3, the costs are expected to be recovered through future revenue from that contract. Now listen closely, because this is the kicker. All three of these criteria must be met simultaneously. You can't just pass 2 out of 3 and decide to capitalize. It is a strict package deal. So what does directly relates actually mean in the real world when we look at that first criterion? Well, consider the difference between specific attributable costs and general overhead. General overhead, like your facility rent, the company's IT infrastructure, or executive management time, might support the contract in a broad, general sense, but it completely fails the test. You expense those. To capitalize something, a cost must be specifically attributable to the contract in question. And how are you going to prove that to an auditor? You need receipts, literally. You need job costing records, project timesheets, or a highly documented allocation methodology. If you don't have those specific, traceable records, auditors are going to reject the capitalization every single time. No exceptions. And finally, Part 5, Real-World Fulfillment Scenarios. Let's see how we apply these criteria in practice. All these rules sound great in theory, but we all know accounting happens in the trenches. So let's do a rapid-fire review to see how this shakes out in the real world. SaaS setup and onboarding? Yep. Assuming criteria are met, you capitalize it because it directly relates to a specific contract and generates a configured resource for future performance. What about project site mobilization? Like flying a specialized crew out to a specific project site? Yes, again, it relates to that specific contract and creates the capacity to perform the work. Custom customer inventory? Nope. Remember that gateway check we just talked about? That goes straight over to ASC 330. And finally, let's look at a classic trap. General staff training. This is almost always a hard no. Why? Well, if the skills an employee learns are transferable and can be used on any engagement, it fails criterion 2. It doesn't generate a resource specific to this one contract. Unless the training is incredibly niche, contract-specific, and non-transferable, you are expensing it. And there you have it. You are now fully equipped to navigate the practical expedient, sidestep its hidden traps, and apply the rigorous 3-part test for fulfillment costs. But this does leave us with a bit of a cliffhanger. Once you've gone through all this work, jumped through the hoops, documented on your timesheets, and successfully capitalized these contract costs, exactly how long do you amortize them for? How do you calculate that period, especially when things like renewals get thrown into the mix? Well, that is exactly what we are going to unpack in Section 4, Measurement, Amortization, and Impairment. It's a great one, so I'll see you there.